I predicted that we would see a 12% increase in prices this year and an 8% increase in rents this year.
Mm.
And I think I'm going to be right on, even with the higher rates. Now, granted, if rates go up much higher, that could certainly change things, but we're still just lacking inventory. Prices are still appreciating, even in the face of higher rates. 40% of US homeowners own their home free and clear. So that portends that there's not going to be a foreclosure crisis with those 40% of people.
One thing I wanted to go over is adjustable rate mortgages increasing.
Yeah.
But one thing I found fascinating in looking at a chart is the average price point for an adjustable rate mortgage, as far as the average purchase price of the home that's being used with an ARM is way higher than fixed rate. I mean, it was up around $700,000-800,000.
Yep.
That's the average sale price for a home where the buyer is using an adjustable rate mortgage. And I believe the average sales price for a fix was right around 250, 300. So why is that, first and foremost?
Well, I'm not sure, but it could signify that people are using the adjustable rate mortgages to stretch a lot more,
Right.
which in the long run could be a problem. As we know, the Great Recession was largely caused by this sort of, we all probably saw this one time in our life in maybe biology class in school or something where, they fed like a rat to a snake, right? And, you got this big bulge going through the snake. It's really weird looking. And that's what happened the last time around with these adjustable rate mortgages, where they gave them a teaser rate, and then 5 years later they got a 3-1 arm or a 5-1 arm, and then you had that adjustment and it caused payment shock. This time though, I hate to say it's different, but I'll say that a little bit because, of course, they're much more careful of how they're underwriting, even the adjustable rate loans, and they tend to be longer. Most of them are 7 years before they start adjusting.
So I'm trying to figure out the percentages right off the top of my head. I remember this article that I saw on CNBC said that demand for ARMs are at a 14-year high.
Yeah.
But they're not at the levels yet that they were, call it 2006. Then they were
Right.
about 30% of the overall mortgage market. And recently they've gone from about 3% up to 11% of total mortgages. But when you combine the total value of all those mortgages, they're up at 19%.
Mm-hmm.
And so another thing that I was thinking about is if that's a higher end buyer, my theory was that their purchasing power would be more impacted by the stock market. And if the Fed is raising rates, if stocks are coming down, like we've seen significantly in the NASDAQ, that may affect their ability to buy homes. And if they get squeezed with that adjustable rate, then that could put further pressure on the prices at the high end, even nominal prices.
Yeah, that's a good point. And the wealth effect is dissipating to some extent, as we've seen the crypto markets encounter tough times, the stock markets. The only thing holding up so far, really, is an asset class, is real estate. But again, that may not last because we are seeing a little bit of a transition. And, it's kind of like the weatherman says, George, TETT, too early to tell. But I think the next 2 months are going to be very telling as to the direction of the real estate market because we see inventory uptick a little bit, but it's still such a small amount. It's just not significant yet. But we'll see. I mean, Redfin says demand has declined a bit. Requests for home tours and so forth has declined a bit, but we got a long way to go before supply and demand meet in sort of that sweet spot of what we'll call a normal market.
Okay, so you got 140 million homes. And I was looking at a chart from, I believe, the New York Times that showed that on average, there's about 500,000 homes for sale in the United States. That was throughout 2021. So you can have, if there was let's say Blackstone just dumped 80,000 of the homes they have, that would affect the price significantly for all 140 million homes, even though there's a very low percentage of those homes that are actually for sale.
If Blackstone dumped 80,000 homes on the market all at once, which they probably wouldn't ever do it all at once,
No, I think
that would,
they definitely scale it over a period of time, but I definitely think it can
right.
impact that equilibrium of supply and demand that we were talking about.
Yeah, I agree with you. It definitely would. However, it depends how quickly that inventory is absorbed by the buyers. And you see a lot of people on YouTube and read a lot in the media about people talking about the forbearance and the foreclosures that would have happened but didn't happen because of forbearance and eviction moratoriums and all of this kind of stuff, right? But what they don't tell you, and there's one particular guy on YouTube that I want to get on my show. He agreed to come on a long time ago, but then never booked the interview. And I'm going to get him. You might know who I'm talking about, who's been really gloomy about the real estate market for about a year and a half to 2 years. And it's kind of faulty what he's saying, because he says there would have been another 700,000 homes that would have come up for sale, right? And let's assume he's right about that. Let's give him that, which is a huge leap to give him that, right? But let's say he's right. What he doesn't tell you, he acts like it comes on all in one snapshot at time, and that inventory doesn't come on sporadically, right?
Right.
And of course, the demand and the absorption happens sporadically as well. So this stuff is harder than it looks to figure out, right? Because
And then he's also just saying, well, if the government wouldn't have done this, but yeah, you have
right,
to consider the government right now. And that's what I always say on my videos, is to answer economic questions, you have to start by answering political questions
right,
in today's day and age. That's just the reality. In fact, I did a whiteboard video just this morning where I asked the question, are real estate prices going to crash? I think.
right,
And I went through all these reasons why the prices could come down. But the conclusion of that video is no, they won't crash. Number one, because real estate prices never crash. Even if you go back to the GFC, it took them 6 years
right.
to go from their peak down to their trough. So
Yep,
that's not a crash in my mind. A crash is the stock market in March of 2020.
right.
When it's down 20-30% within the matter of weeks, that's a crash.
That I
uh,
agree.
but we
Yeah,
could see nominal prices come down, definitely could see real prices come down when you adjust for inflation. But the other conclusion I came to is that although we could see nominal prices come down, like I just said, I think the government would step in and try to come up with some sort of scheme, even if inflation was running hot, in
right.
order to prop up the market. Because number one, they're not smart enough to connect the two, home prices and the
Amazingly.
CPI,
Yeah.
right? Purchasing power, aggregate demand. But number two, we have this weird thing with even with the average Joes and Janes, that for some reason consumer price inflation is really, really bad, but asset inflation is really, really good.
Yeah, right.
You notice that? So as long as we have asset inflation, well, that's great. We just
Yeah,
don't want the consumer price inflation, as
right.
though they're not connected in any way. So I think even if the CPI was running hot at 9-10%, like we saw come out in the UK today, by the way, I don't know if you saw that CPI print,
Yeah,
9%, their highest
that's
since they've
crazy. Yeah,
tracking their CPI.
yeah.
But
So just double that for the real number.
Yeah,
Yeah,
exactly.
right.
Exactly. But even if we get to that level, I think the central planners could still justify some sort of housing scheme to try to prop
Mhm.
up the markets, because they just, the average Joe doesn't connect those dots. I don't know if you saw what they're
Right. They
proposing
they
in Australia right now. Did you see that? Did you see what they're proposing down there to try to prop up their housing market?
no, what, more quarantines and police state? I'm just kidding. I mean, unbelievable.
I wouldn't doubt it, but no, they're proposing this scheme where the government buys 40% of your house.
Oh, yeah, I did hear like an inkling of that, but I didn't dive into
So
it.
you
That's
only have to come up with the down payment and make monthly payments for
mhm.
60% of the
Wow.
purchase price. But the government has a 40% equity position in your house.
Well,
So
you know what they say, George, you'll own nothing and you'll be happy. So
that's
that's the first
exactly what
step.
I said in
Right.
my
Yeah.
video.
Yeah.
Exactly.
Oh, I didn't see your video, by the way.
Well, no,
We're
it's not
thinking
out yet.
alike.
It's not out
Okay.
yet, but that's
Yeah.
when I mentioned that fact. I
Yeah.
said maybe this is how we get to 2030, where
Right.
you own nothing and you'll be happy.
Right.
They, in the article, it just talked about housing prices going up. So they say
Yeah.
when housing
Right.
prices go up and then you sell, then all you have to do is pay off the government their 40% equity position. But I'm like, okay, well, what if prices go down? Your equity gets wiped out. You can't make the payment. And where does the house go? Well, it goes right back to the government. They're the
Right.
ones that own it.
Yeah.
And anyway, I don't want to go down that
That's
path,
how
but
they end up owning everything. Yeah.
yeah, yeah, yeah.
Yeah, that's unbelievable.
So
Yeah,
what do
because
you think that
it seems to me like the Fed really, they should have been raising rates more slowly, much earlier, right? They let the economy heat up too long, in my opinion. But the most recent increases are too knee jerky. They're too sudden and too severe, I think. They should have just done that more gradually. I mean, I don't think they should do anything because I don't think we should have a centrally planned economy, but we do. And I just think they acted too abruptly when they should have acted more slowly, but they should have done it a long time ago. You know, they should have started hiking a while back.
Yeah, I mean, I think they're in a position right now where they have to hike. I don't know that they're hiking aggressively, and I mean, it depends on what your objective is.
Yeah.
They can't hike too much. I think they're doing the only thing they really can do, and that's try to just gradually hike rates. I mean, let's not forget we're talking like we're at 7% or something. We're at
Right.
75 basis points for heaven's sakes.
Fair enough.
You know,
Yeah.
it's not like we're at even 2% or 3%.
Right.
But what they're trying to do is talk down asset prices. So they don't actually have to raise rates in order to bring down that CPI print.
Yeah.
So they know that if they took Fed funds to 3%, 4%, 5%, that would crush everything. The stock market, that I think would crush the housing market,
Right.
and nominal prices would come down
Yeah.
because, you know, mortgage rates would be at 10%, for heaven's sakes. And then the economy would come crashing down with it. So they know that getting interest rates up to a certain level is not an option. So let's just gradually raise them and act and talk like we're Paul Volcker.
They're right.
So then
And
hopefully asset prices will just gradually come down to a level
we'll
that's
have a soft
where
landing.
the
Yeah.
CPI is palatable from a political position.
What's interesting is that mortgage rates are still well below CPI inflation, which is a very rare occurrence in history,
Yeah.
and they're raising them less at a slower pace than inflation, which is also interesting. And then, of course, real inflation is maybe 15, 16%, and you know, mortgage rates are still about a third of that. So if there's still a huge arbitrage opportunity, even with the higher rates, but for investors, the rents have yet to catch up with the prices. Now they've been rising quickly, but the prices have been rising more quickly, and the rents always lag by about 2 years. So
Your
investors are
RV
kind of in
ratios
this
are getting
position
squeezed.
where what's that?
Your RV ratios are getting squeezed.
Absolutely, the rent to value ratio is getting squeezed. Yeah.
Hmm. Well, let's kind of think through that because I was actually on a podcast last night where we were talking about real estate and they were asking my opinion, you know, what do I do? What do I do? What do I do as a real estate investor? And I said, you know, you have to start with what your objectives are. Because if your objectives are to never sell, and if you're just trying to buy positive cash flow and maybe take a prudent path to short the dollar, then I think it can make sense in certain instances, especially if you have an edge when it comes to property management and
Yeah.
all those things that really make or break a real estate portfolio. But if you're someone that wants to do a cash out refi in 2 or 3 years, and if you're someone with an adjustable rate mortgage, or if you're someone that buys a property that has negative cash flow, expecting the appreciation to bail you out, then I wouldn't touch it with a 10-foot pole.
Yeah.
You know, what advice do you give for real estate investors in this type of market? And then maybe after that, let's think through what advice we would give a potential homeowner who's just trying to consider whether now is a good time to buy or sell.
Yeah, well, you know, of course it depends where, right? Location is obviously important. If you're in a cyclical market, you're going to feel a downswing in the market more abruptly than in a linear market. But I predicted that we would see a 12% increase in prices this year and an 8% increase in rents this year.
Mm.
And I think I'm going to be right on, even with the higher rates. Now, granted, if rates go up much higher, that could certainly change things. But we're still just lacking inventory. Prices are still appreciating, even in the face of higher rates. 40% of US homeowners own their home free and clear. So that portends that there's not going to be a foreclosure crisis with those 40% of people anytime soon. I mean, people that have a property free and clear tend not to be foreclosed on. It's pretty rare. It'd be for property taxes or litigation or some other thing. So I think keep buying. I think that, we may go through a downswing in the market. Who knows? But in 5 years, 7 years, 10 years, the prices are likely to be higher than they are today. But like you said, don't invest based on expecting appreciation. That's a dangerous thing because appreciation is not that reliable. Cash flow or rents are much more consistent and reliable than price increases. So people in cyclical markets, they buy on the come. The property never makes sense the day they buy it, and they buy it simply with expecting some great appreciation to occur. It doesn't happen, and they're wiped out. And that's what we see in cyclical markets. But in good, solid linear markets, the deal still works nicely.
Yeah, I still think you got to have an edge, and you got to know that you're playing with fire. You just have to understand that you're buying when prices are incredibly high and very expensive. And so if you're someone who just wants to buy a stream of cash flow and you never want to sell the property, it's just like a McDonald's. I used that example yesterday. If I was buying a McDonald's, I'm buying it for the $100,000 or $150,000 it throws off every single year in profit. I don't care about the price of my McDonald's, what I could sell it for in 2 years, 10 or even 10 years, because I never want to sell it. So if you're that type of investor, then I think, move forward, but tread carefully. But if you're the type of investor where you set things up to where you have to sell in 2 years or 3 years,
not a good
my
plan.
goodness gracious. Yeah,
not a good plan at all.
Yeah. Yeah. You're asking for big problems right there.
Absolutely agree. But George, housing prices, it's interesting when people say they're high or they're low, right? You've got to adjust obviously for the price of the house, the mortgage interest rate, and inflation, right? Those three things are the three main ingredients you have to adjust for. And I did a chart where I looked at mortgage payments on the median price house throughout history for the last 52 years. And I adjusted them for CPI inflation, and then I adjusted them for ShadowStats inflation. And when you adjust that, and I'd be glad to share this as a visual if you'd like, but when you adjust that, the mortgage payment today, believe it or not, is at the lowest point in the last 52 years, with the exception of 2020. It was lower then, adjusted for CPI inflation or ShadowStats inflation, either one.
Yeah, but again, this all depends or is predicated on you holding the property. Because if you're ever planning on selling the property, then even though the payment might be low now, interest rates go up, and it might not affect your payment, but it's going to affect the payment of those people that you want to sell to.
Great point. So that shows us it's kind of like being a bondholder, right? Because if you have that cheap mortgage, number one, you have a sustainable investment where you're not likely to need to sell because the deal works pretty well, right? But also you have an asset that's actually becoming more valuable. That mortgage, when there's higher rates all around you and you can't replicate that cheap mortgage, your mortgage is now even a more valuable asset because nobody can get money that cheap anymore, right?
On your balance sheet, yeah.
Yeah, on your personal balance sheet or your household balance sheet. And so, as I've said before, this is going to cause people to hoard their houses if they can, right? They're going to do whatever they can to hoard those houses. They're going to remodel them, they're going to fix them up instead of moving. Or if they're in trouble, they're going to take on roommates. They're going to do whatever they can to keep that mortgage asset because it won't transfer to the new property, right? And so that's going to actually constrict inventory in the coming years. And I think that's the poison pill that the Fed has put into the housing market. And when I say poison pill, I mean in a good way for investors that own already, but in a bad way for first time buyers trying to get into the housing market. It's going to constrict their choices even further.
Yeah, yeah. I mean, I see a lot of cross currents there because
Yep.
I think that as rates rise, you pull demand forward, but I think you could come up in a scenario where you're increasing supply artificially, if maybe just temporarily.
Yep.
Well, and what I mean by that is if you're a person that's thought about selling your house, let's say over the last year, now all of a sudden you're incentivized to sell. You want to sell now because you're seeing interest rates go up and you're thinking, I need to sell right immediately. I don't want to wait because if I wait, there could be fewer buyers, or the buyers that out there might not be able to afford the price I want to get for my house. So I see that as another potential issue on the supply side, or increasing supply, while at the
If you're
same
not
time, you know,
Yeah. So if you're not one of the tens of millions of people who've either refinanced their house or investment property or purchased and locked in one of these historically low interest rates, then you will be more motivated to do that. I couldn't agree more. But so much of the market has already locked in those low rates, and that mortgage actually becomes more and more valuable in a rising rate environment. It's more
yeah.
valuable to you.
Yep, 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 yep. I also too worry about, or again, there's just all these cross currents.
Yeah, there are.
I worry about people's purchasing power because their real wages are going down to such a significant degree.
I'm glad you mentioned that because that's another thing that's harder to calculate or understand, I
Yeah.
think. And so when you look at the house itself, the deal looks pretty good. Okay. It really looks pretty good. It's still cheap when you adjust for inflation, either by CPI or ShadowStats. I can compare it to all sorts of
Well, the
things in the
mortgage
Hartman
payment
comparison
is, but
index.
the housing price is not.
Yeah.
I mean, we're still adjusted for inflation. We're at all-time highs.
Right. But that monthly payment is still very low historically. But here's the problem. Here's the cross current for you, and you just alluded to it. The burden on the household from other non-housing expenses
Right, right.
has risen dramatically. The price of food, the price of gas, the price of healthcare. And that burden is what's really harder to understand how that is going to impact their ability to buy houses. And I want to make sure we talk about one other thing, and that's the prediction I made about 2 months ago that we're going to see a lot of builder cancellations, a lot of contract cancellations. And I can suss that out with you if you'd like, because I think it's an interesting thing to think about.
Yeah, let's go through that because I was reading a story in the Wall Street Journal. I think I actually referenced it in my whiteboard video where they were talking about how higher mortgage rates really affect new home buyers. And I hadn't really thought about that, but they outlined in this article how new home buyers usually buy the house prior to it being built.
Right.
So let's rewind to 2021. If you're the
Yep.
average Joe and Jane first-time home buyer, you're out there putting down a $5,000 deposit on this house that will be built in the future, and you're calculating what your mortgage payment is going to be based on, let's say, a 3.5% interest rate.
Yep.
Well, fast forward to a year where now all of a sudden you've got to buy the house and interest rates
Yeah.
or mortgage rates are at 5.5%.
Yeah.
And you can't afford that payment anymore.
Right.